Well, first up, if I can get this technical story out of the way, the SEBI saying that overall exposure of mutual funds to NBFCs plus housing finance companies should be 30% and not 40%. Have you all done the industry math? Is the industry over-invested much more than 30% in these two papers?
Well, it's more for the fixed income
Yes.
team to really figure those things out. But at the end of the day, what it does mean is, the NBFC sector has been one of the biggest borrowers in the market. So what it will mean is there will be surplus liquidity in mutual funds that they'll have to look at other rated papers, maybe go down the curve a little bit. But it is a critical, large component of most funds, and this is some sort of obviously a risk control measure. So funds will have to look at alternate ways of deployment. So yeah, it will create the room for more paper in other areas.
Okay.
Well, we have some math that at the moment the CPs of NBFCs and housing finance companies account for just about 14.5% of the total 9.3 lakh crore, which is with the fixed income category. Can you give us some confirmation of that figure? That's what we picked up.
So Lata, I don't know the exact numbers on that, but I do know that at the end of the day, it is one of the largest single sector exposures that mutual funds do have. And now for the NBFCs, they've got other avenues of raising money, including ECBs and other forms of capital. So frankly, I don't think it changes things too much, because they will find other ways of raising money, and funds will find alternate sectors to deploy money into.
Okay. Anup, hi, good morning and Happy New Year to you. How have you been reading into the complete global mayhem that we've seen lately? Does this in any way resemble the crash that we saw in 2008?
Yeah, I mean, it's a lot of people are drawing some parallels to it, but I've got to say, I mean, we're very differently positioned today than we were in 2008. In 2008, all markets were at all-time highs pretty much. If you use market cap to GDP ratio, huge negative sentiment in one direction always offers some degree of an opportunity on hindsight. We've seen this time and again. So over a period of time, for a slightly longer term investor, these present pretty interesting opportunities to invest actually. But over the last 7-8 years, there's been massive divergence. So while the US is still pretty high on market cap to GDP, we've come down to about 80%. A lot of other emerging markets are way below that as well. So I think the sort of effects that some sort of global correction would differ from market to market. I don't think it's the same degree of negativity across the board as we saw in 2008 that all markets will experience, because they've already